Hey there, Iggy the Investing Iguana here. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 410,000 reads. Are you ready to discover the secret to earning passive income without the hassle of being a landlord? In this video, I'm going to introduce you to the world of REIT investing. Picture this: you're sipping a cool drink on a sunny beach while your investments work hard for you in the background. Sound too good to be true? Well, it's not. With REITs, you can invest in real estate and collect regular rental income without dealing with pesky tenants or fixing broken toilets. But what exactly are REITs? How do they work? And most importantly, how can you get a slice of this delicious passive income pie? Don't worry, I'll break it all down for you in simple terms. No fancy jargon, I promise. We'll explore the different types of REITs out there, from residential to retail, healthcare to hospitality. I'll show you how to pick the right REITs for your investment goals and risk appetite. And of course, we can't forget about everyone's favorite topic, taxes. I'll explain how REIT dividends are taxed differently from regular stock dividends. By the end of this video, you'll have a solid understanding of REITs and how they can fit into your investment portfolio. Whether you're a seasoned investor or just starting out, this video is packed with valuable insights and actionable tips. So grab a notepad, get comfy, and let's dive into the exciting world of REIT investing together. First off, what exactly is an S-REIT? An S-REIT, or Singapore Real Estate Investment Trust, is essentially a corporation that owns and manages income-producing real estate properties, primarily in Singapore, but it can also include properties overseas. This can encompass a wide range of property types, including commercial, residential, industrial, and retail properties. When you decide to invest in an S-REIT, what you're essentially doing is purchasing shares in that corporation. In return for your investment, you receive a portion of the income generated from the rental properties owned by the S-REIT. This is akin to having a piece of the proverbial rental income pie, which can be quite a lucrative proposition. The most enticing aspect of investing in S-REITs is the potential for significant cash flow. By law, S-REITs are required to distribute at least 90% of their taxable income to shareholders. These distributions are similar to dividends that you might receive from investing in other types of stocks. However, the key difference here is that the distributions from S-REITs can potentially provide a steady stream of income, which can be particularly appealing for investors seeking regular income. Some S-REITs even offer distribution yields as high as 5 to 8%. To put this into perspective, a high-yield savings account at a bank might offer an interest rate of around 1 to 2%. Therefore, the potential returns from investing in S-REITs can be considerably higher. This makes S-REITs an attractive investment option for those looking to maximize their income potential without having to actively manage the properties themselves. It's like having your cake and eating it too. Understanding the different types of S-REITs available is crucial to making an informed investment decision. Each type of S-REIT specializes in a different category of real estate, and the performance of your investment can be influenced by the market conditions of that specific sector. One of the main categories of S-REITs is office REITs. As the name suggests, office REITs own and manage office buildings. These properties are leased out to various businesses and corporations, providing a steady stream of rental income. The tenants can range from small businesses to large multinational corporations, and the lease agreements are often long-term, which can provide a stable income for the REIT. Examples of office REITs include Keppel REIT and Manulife US REIT. Keppel REIT owns a diverse portfolio of premium office properties in Singapore and key cities in Australia and South Korea. On the other hand, Manulife US REIT invests primarily in income-producing office real estate in key markets in the United States. Investing in office REITs can be an attractive option due to the potential for stable income. However, the performance of office REITs can be influenced by various factors such as the overall health of the economy, the demand for office space, and the vacancy rates of the properties. Therefore, it's important to consider these factors and conduct thorough research before investing in office REITs. Industrial REITs represent another category of S-REITs that you might consider for your investment portfolio. These types of REITs focus on investing in industrial properties, which can include a wide range of facilities such as warehouses, logistics centers, and data centers. When you invest in an industrial REIT, you're essentially buying into a portfolio of these types of properties. The income generated from these properties comes from the rent paid by the tenants, which can include businesses involved in manufacturing, logistics, data management, and other industrial sectors. Two notable players in the industrial REIT space are Capital & Ascendas REIT and Mapletree Industrial Trust. Capital & Ascendas REIT is one of the largest diversified real estate investment trusts in Singapore, with a portfolio that includes logistics and distribution centers, business and science park properties, and industrial properties. On the other hand, Mapletree Industrial Trust's portfolio includes data centers, business park buildings, and flatted factories, among others. Investing in industrial REITs can be an attractive proposition due to the growing demand for industrial spaces, driven by trends such as e-commerce and digital transformation. However, similar to other types of REITs, the performance of industrial REITs can be influenced by various factors such as the overall health of the industrial sector, the demand for industrial spaces, and the vacancy rates of the properties. Retail REITs are another category of S-REITs that focus on owning and managing retail properties. These properties typically include shopping malls and retail spaces that are leased out to a variety of tenants, including department stores, supermarkets, restaurants, and other retail businesses. When you invest in a retail REIT, you're essentially buying shares in a portfolio of these retail properties. The income generated from these properties comes from the rent paid by the tenants. This can provide a steady stream of income, especially since retail spaces are often leased out on long-term contracts. Two major players in the retail REIT space are Frasers Centrepoint Trust and Starhill Global REIT. Frasers Centrepoint Trust is a leading retail REIT in Singapore, with a portfolio that includes some of the country's most well-known and frequented shopping malls. On the other hand, Starhill Global REIT has a diverse portfolio that includes prime retail and office properties in various countries, including Singapore, Australia, Malaysia, China, and Japan. Investing in retail REITs can be an attractive proposition due to the potential for steady rental income and the opportunity for capital appreciation as the value of the retail properties increases over time. However, the performance of retail REITs can be influenced by various factors such as consumer spending habits, the health of the retail sector, and the location and quality of the properties. Hospitality REITs are a unique category of S-REITs that focus on the ownership and management of properties in the hospitality sector. These properties typically include hotels, serviced residences, and other types of accommodation facilities. When you invest in a hospitality REIT, you're essentially buying shares in a portfolio of these hospitality properties. The income generated from these properties comes from the rent or room rates paid by the guests. This can provide a steady stream of income, especially since hospitality properties often have high occupancy rates due to tourism and business travel. One notable player in the hospitality REIT space is Capital & Ascendas Trust. This REIT is known for its extensive portfolio of serviced residences and rental housing properties around the world. The properties under Capital & Ascendas Trust are managed by the Ascot Limited, one of the leading international lodging owner-operators. Investing in hospitality REITs can be an attractive proposition due to the potential for steady income and the opportunity for capital appreciation as the value of the hospitality properties increases over time. However, the performance of hospitality REITs can be influenced by various factors such as the health of the tourism sector, the demand for accommodation, and the location and quality of the properties. Healthcare REITs are a specialized category of S-REITs that focus on owning and managing properties in the healthcare sector. These properties typically include hospitals, medical centers, nursing homes, and other healthcare facilities. When you invest in a healthcare REIT, you're essentially buying shares in a portfolio of these healthcare properties. The income generated from these properties comes from the rent paid by the healthcare providers that occupy these facilities. This can provide a steady stream of income, especially since healthcare is a critical service that is always in demand. One notable player in the healthcare REIT space is Parkway Life REIT. This REIT is known for its extensive portfolio of high-quality healthcare and healthcare-related properties across Asia, including hospitals and nursing homes. The properties under Parkway Life REIT are managed by Parkway Hospitals Singapore, one of the leading private healthcare providers in Asia. Investing in healthcare REITs can be an attractive proposition due to the potential for steady income and the opportunity for capital appreciation as the value of the healthcare properties increases over time. However, the performance of healthcare REITs can be influenced by various factors such as the health of the healthcare sector, the demand for healthcare services, and the location and quality of the properties. Data center REITs are a relatively new but rapidly growing category of S-REITs. These REITs focus on owning and managing data centers, which are facilities used to house computer systems and related components, such as telecommunications and storage systems. In the digital age, data centers have become increasingly important as they provide the necessary infrastructure for many businesses and services that operate online. This includes everything from cloud computing and online gaming to digital streaming and e-commerce. As such, the demand for data centers has been growing, making data center REITs an attractive investment option. One such data center REIT is Keppel DC REIT. This REIT is known for its extensive portfolio of high-quality data center properties located in key data center hubs across the world. The properties under Keppel DC REIT are managed by Keppel Data Centers, one of the leading data center operators in Asia. Investing in data center REITs can be an attractive proposition due to the potential for steady income and the opportunity for capital appreciation as the value of the data center properties increases over time. However, the performance of data center REITs can be influenced by various factors such as the demand for data storage and processing, advancements in technology, and the location and quality of the properties. Diversified REITs are a unique category of S-REITs that own and manage a variety of different types of properties. This can include any combination of the property types we've discussed so far, such as office buildings, industrial facilities, retail spaces, hospitality properties, healthcare facilities, and data centers. The main advantage of investing in a diversified REIT is the diversification it offers. By owning a mix of different property types, these REITs can spread their risk across different sectors of the real estate market. This can provide a level of protection against fluctuations in any one particular sector. For example, if the retail sector is experiencing a downturn, a diversified REIT that also owns office buildings and industrial properties may still be able to maintain steady income. In addition, diversified REITs can take advantage of opportunities in different sectors as they arise. If one sector is performing particularly well, a diversified REIT can allocate more resources to that sector to maximize returns. This flexibility can be a significant advantage in the dynamic and ever-changing real estate market. However, as with any investment, it's important to understand the specific characteristics and risks associated with diversified REITs. While diversification can spread risk, it also requires expertise in managing different types of properties. Therefore, when considering investing in a diversified REIT, it's important to look at the management team's track record and expertise in the various sectors in which the REIT invests. When considering an investment in S-REITs, it's important to approach it as if you were buying the properties outright. Imagine if you had an unlimited bankroll and could purchase any property you wanted. What kind of properties would you choose? Would you opt for a bustling shopping mall, a state-of-the-art data center, a luxury hotel, or a high-demand warehouse facility? Your answers to these questions can guide your choice of S-REITs, as different REITs specialize in different types of properties. However, it's crucial not to be swayed solely by an S-REIT's high distribution yield. While a high yield can be attractive, it's just one aspect of the investment. It's equally important to examine the properties that the S-REIT owns. Are they high-quality properties in desirable locations? The location and quality of the properties can significantly impact the rental income and, consequently, the distribution yield. Next, consider the quality of the tenants. Are they reliable, with a strong track record of paying their rent on time? Do they have long-term leases, providing a steady income stream? The quality of tenants can affect the stability of your returns. Additionally, take a look at the S-REIT's debt levels. While debt can be used to finance growth, excessive debt can be risky. If interest rates rise, the cost of servicing that debt can eat into the S-REIT's profits. Therefore, it's important to choose an S-REIT with a manageable level of debt. Finally, consider the S-REIT's growth prospects. Does it have a strategy in place to acquire new properties and increase rental income? An S-REIT with strong growth prospects can potentially provide increasing returns over time. If you're keen to learn about the various important indicators to rate or review a REIT, you can refer to this video for an in-depth understanding. If the idea of conducting extensive research on individual S-REITs seems daunting, an alternative option is to invest in an S-REIT exchange-traded fund, ETF. An ETF is a type of investment fund and exchange-traded product that is designed to track the performance of a specific index, sector, commodity, or asset. In the case of an S-REIT ETF, the fund invests in a diversified portfolio of different S-REITs. This means that instead of having to research and select individual S-REITs to invest in, you can simply buy shares in an S-REIT ETF and gain exposure to a wide range of S-REITs. This can provide instant diversification, as the performance of the ETF is not tied to the performance of a single S-REIT, but rather the collective performance of all the S-REITs it holds. Investing in an S-REIT ETF can be a more manageable way to invest in real estate, especially for those who are new to investing or those who prefer a more hands-off approach. It eliminates the need to monitor the performance of individual S-REITs and adjust your portfolio accordingly. Instead, the ETF does this work for you. However, as with any investment, it's important to understand what you're investing in. Be sure to research the S-REIT ETF, including what S-REITs it holds, its investment strategy, and its track record. And remember, while an S-REIT ETF can provide diversification, it doesn't eliminate risk. The value of your investment can still go up or down, and you may lose money. One of the unique aspects of Singapore real estate investment trusts, S-REITs, is their international reach. Many S-REITs own properties not just in Singapore, but also in developed markets overseas such as the United States, Europe, Australia, and Japan. This international exposure can be a significant advantage for investors. Investing in S-REITs that own properties overseas allows you to diversify your investment portfolio geographically. This means that your investment is spread across different countries and markets, reducing the risk associated with investing in a single market. For example, if the real estate market in one country is experiencing a downturn, the impact on your overall investment could be offset by the performance of the properties in other countries. Moreover, investing in international properties through S-REITs gives you exposure to real estate markets that you might not otherwise have access to. This can provide opportunities for higher returns, as these markets may offer higher rental yields or capital appreciation potential compared to the local market. However, investing in S-REITs with properties overseas also introduces additional factors to consider. One of these is the impact of foreign currency fluctuations. When you invest in an S-REIT that owns properties overseas, the income from those properties will be subject to exchange rate fluctuations when converted back to your home currency. This means that changes in the exchange rate can affect the value of your investment and the income you receive. For example, if the home currency strengthens against the foreign currency, the income from the overseas properties when converted back to the home currency will be lower. Conversely, if the home currency weakens, the income will be higher. Therefore, it's important to consider the potential impact of foreign currency fluctuations on your investment returns. In summary, S-REITs offer a unique opportunity to invest in a variety of real estate sectors, both locally and globally, without the hassle of property management. By law, they pay out at least 90% of taxable income as distributions, which means you could earn regular passive income. However, it's crucial to do your due diligence on the S-REITs property portfolios, financials, and growth strategies before investing. And of course, never forget the importance of diversification in managing your risks. And there you have it, folks, the ultimate guide to earning passive income with REIT investing. I hope this video has demystified REITs for you and shown you how accessible this investment vehicle really is. Remember, investing in REITs is not a get-rich-quick scheme. It's a long-term strategy that requires due diligence, patience, and a well-diversified portfolio. But with the right approach, REITs can be a powerful tool for generating steady, passive income streams. If you found this video helpful, do me a solid and smash that like button below. And if you want to learn more about smart investing strategies, be sure to subscribe to my channel, The Investing Iguana. I post new videos every week, covering everything from stocks to bonds, ETFs to mutual funds. Thank you for watching, and as always, stay curious, stay invested, and stay awesome. See you in the next video.